an investor doing things on your own? How about someone working with a firm that isn't so responsive or in sync with your investment philosophy? My podcast talks you through all things financial. Look, there's stuff you don't deal with very often, but investments, insurance, and retirement is something we plan for each and every day. This is the PennyWise Financial Podcast, and welcome to the show. Welcome to the PennyWise Financial Podcast. This is Constantine here at Monarch Wealth Management with my co-host, Jason Georgiev. Welcome to the show, everyone. Today's Wednesday, November 16th.
Cold Wednesday.
Cold one, yeah. It's been colder the last few days.
I think it's staying cold now. We got a little snow on the ground.
We got spoiled, though, didn't we?
We did. It was nice.
To me, it was a long fall.
Yeah. But we had some warm weather.
Yeah, I'm not talking about the stock market falling. I'm talking about it being a long season. Like it almost faked me out into forgetting that winter was on the horizon.
Yeah.
And then we got some white flurries, wet.
I wish it would have stayed around.
Yeah, I know.
That warm weather. It was so nice.
The leaves are pretty, changing colors, right?
Yeah. Well, they're almost gone now, actually.
Not unless you come to my house.
You have a lot
got
of
like
leaves?
1 million trees.
Still with leaves?
Still with leaves.
Oh, wow. Most
I'd
of
say
them in my house are
it's
gone.
probably like 80%. I mean, there's not a lot, but there's still more to fall.
Yeah. I don't have much at all.
We can't keep up with them.
Yeah, I tried, but... And then the snow hits, then you can't do anything with the leftover leaves.
So what do? Do you blow them?
I blow
rake them?
leaves, yeah.
Or combo?
No raking.
Okay, no rake.
Nope. Blow and mow.
Blow and mow.
Yep.
Okay.
Shred 'em up.
Blow and mow. Well, hopefully we're not shredding up the market. Why don't we take a look at the top sectors of the market? I don't mean top necessarily by virtue of their performance, but let's jump into the major sectors. Tell us what things are looking like.
Dow Jones for a year to date, we're at negative 8.24.
Negative. Okay. We got that cleared up from last week. I'm glad to hear that.
And NASDAQ's looking at negative 29.34.
Oof.
That's not so nice. S&P 500, we're at negative 17.34. And the Russell 2000 is at negative 18.29.
Wow.
Not looking too nice.
No, I don't like any of those numbers. I mean, I guess the one that's faring the best is the Dow Jones.
Looks like it, yeah.
And then, so those are year-to-date numbers.
Mm-hmm.
We get this report that comes out every week, and it takes a snapshot of what happened last week and highlights some things.
Yeah.
Any idea what the best performing sector of those ones you just mentioned, which one did the best last week?
I would have to say the Dow.
Believe it or not.
Or actually probably the NASDAQ.
It was the NASDAQ.
Now that I think
You're right.
About it, yeah.
That got hit the hardest, and it also was one of the first ones to start coming back.
Yeah.
And when I say that, if we look at last week, the NASDAQ was up 8+% in 1 week. 8%.
Yeah.
It was also down 35, almost 40% loss year to date. So up 8% is a good number, but it fell pretty hard. All right. It was a falling knife. I don't know that that's the bottom yet. It's up 8% as of last week, but time will tell. We still have a few more months left in the year, this month and next month.
Mm-hmm.
And then the Dow Jones. Dow Jones was up half of that. It was up 4%. It's a pretty nice return in 1 week.
Yeah.
You know,
definitely.
it's been faring the best out of all three of the major ones. And then the S&P. S&P was up almost 6% last week.
Wow.
Those are pretty good numbers, right?
Yeah. Last week was a good week.
It was a very good week.
Yep.
Very, very good week. Some of the more boring stocks, utilities, were kind of trading sideways, and consumer staples. But those were the areas that did pretty well when the market was not doing so hot. And then I also like to take a look at some of the different sectors that I call them. They are like the alternative sectors. First, we look at the XLE. That's the Energy Select Spider ETF. Year to date is up almost 63%. And now we're just kind of touching where we were back in June 6th, when we hit that peak, $92 a share. And now we're sitting at 93.01.
That's pretty good.
Yeah. No, I like the energy sector. we are coming into the colder months. Like we mentioned, the weather is starting to change.
Mm-hmm.
It's not just for us here. It's going to be cold winter in Europe. And I don't know what's going to happen with the war, the looming different ideas about how energy is going to be transported and distributed to different parts and countries in Europe, and what they're going to be paying to heat their homes and keep safe. So I still like that sector as a place to make money. And we also take a look at the financial sector. That's the XLF. That is the Financial Select Spider ETF. Year to date is down 10.9%. So that has not done very well, although it's faring better than the NASDAQ, right? I guess down 30% is not too hard to beat, but it's not saying a lot. But the financial sector, I think, is in a very good position moving forward with higher rates, better balance sheets, like we mentioned from time to time on the show. The Real Estate Select Spider ETF, that's the XLRE. Year to date is down 25.5%. Again, I think a very good place to be when you're trying to fight and find a hedge against inflation. Real estate tends to be, these type of REITs tend to be a good place to battle that or combat that. Now, they haven't performed too well so far, down almost as much as the NASDAQ. But I think as we move forward over time, they're in a pretty good position to help be a decent hedge. And then we start to look at the digital currencies. First, we looked at the Grayscale Bitcoin Trust, the GBTC. And year to date, I imagine it's still down. It's down almost 75%.
Oh, that's it?
Year to date, down almost 75%.
That's crazy.
Yeah, it's not a good place to be. The Grayscale Ethereum Trust, that's the ETHE. That one is down 78% year to date, so even worse than the Bitcoin Trust. And then the smallest of the three, the Grayscale Litecoin Trust, is down 70% year to date. That's LTCN. Not a very good place to be in either one of those. Any one really of those three, not looking too sharp. There's been some headlines too about some of the wallets and miners, and there's a pretty major failure right now going on in that market. And, you see some pretty big names like Warren Buffett speaking out about cryptocurrencies and how we really didn't need any type of digital currency that benefits people who will kidnappers or hold your computer software or your data ransom. Criminals, really, right? I mean, that's really who this caters to. But I do understand there's some practical use for it, for maybe some supply chain companies and things like that might use it. I don't personally think there's any benefits to what we do on a day-to-day basis. I could be wrong, and maybe things will adapt. But right now, I don't see that being a good place to be. How about gold itself? We look at the GLD. That's the Spider Gold Trust. Year to date is down 1.7%. I can remember a few weeks ago, this was down almost 6% year to date. So it is maybe somewhat of a bounce. If I go back to March, it was trading at $191 a share. And now we're at $165. So it has come down from its peak quite a bit, bouncing kind of sideways. But I guess to be down 1.7 is better than down 20 or 30.
Definitely.
Like the NASDAQ.
Yeah.
And you mentioned the Russell down 18+% year to date. So I think that things are starting to evolve and change, and the market itself is showing some promise.
Mm-hmm.
I just don't know if it has staying power. If this trend will continue, I don't know. Now, the technology companies fell the hardest, and I think that some of them are still trading at a very high price to earning multiple. They got numbers based off of estimates that will come years down the road, right? But they're not making that money right now. And people are not willing to pay up for that stuff right now. There's a looming recession. Not everybody, but there are a lot of analysts that say next year in 2023, we can expect a recession. Mm-hmm. We know the election results maybe didn't go the way that many of us thought it would go. Somewhat of a divided government means kind of a gridlock as far as decision making, as far as processes, as far as implementing spending.
Yeah.
Right. Do you want the government to spend any more money?
No.
Do you need any more help? I mean, most people are standing on their feet at this point.
Yeah.
You know,
most people.
Most people.
Yeah.
And I can tell you there are a lot of clients that I'm working with right now, both business owners, self-employed, and even individuals that have cash on the sidelines.
Mm-hmm.
And they're not sure what to do with it.
Mm-hmm.
They're not ready to put it to work in the stock market just yet. A lot of them are debt-free or almost debt-free. And some of the debts they do have might be at 2 or 3%, and they're not paying those off anytime soon.
Yep.
I mean, if you were to go buy a car right now, I imagine the interest rate is probably 5-6+%.
I believe so. Yeah.
Isn't that nuts?
Yeah.
A year ago, they were like 1.9 or 2%.
That's where I locked in, thank God. But mortgage rates now are going through the roof too.
7+%.
Yeah.
And, I've talked to a few local business bankers about this, and they see the rates coming down in the next 3 or 4 months.
Oh, really?
Yeah.
Oh, well, that's good news.
Now, I think there's a difference. So we know what the Federal Reserve is planning on doing. And we think that it's less likely that in December they're going to have a 75 point rate hike.
Increase, yeah.
Maybe it's going to be 50 instead of 75 basis points.
Is that what they're saying?
So, but I think, that's what we're anticipating, at least on the market pundits, experts on TV.
Mm-hmm.
The people that get paid the big bucks to put the makeup on. And,
them.
Yeah, those guys and gals. So, yeah, I mean, but I think there's a difference between letting off of the gas and slamming on the brakes.
Mm-hmm.
And I don't think they're slamming on the brakes.
I don't think so, no.
CPI and PPI, so what the consumer pays for products, and the PPI, what the producers are paying for these products to get made, right? And there's a difference in price. And we start to see what the CPI numbers are looking like. They're coming back in a little bit lower and lower, which is what the Fed wants, right? Those numbers to come down.
Mm-hmm.
They're doing their job. That means it's working.
Yeah. Raising
interest rates is creating people to spend less to slow down the economy. That's what they want to do.
Yep.
So, but I think they're slowing it down. Like I said, I think last week's title was Slow Dance into Recession. That was my title.
Yeah.
You don't love it. No, you don't love it. What are you thinking?
Huh?
This is a fast dance into recession, or there's no recession?
I don't know. I think there might be a recession, but I don't know. Things look strong. Even they were saying the unemployment rate, right, was staying low.
Unemployment is low.
Yeah.
To me, this has always been a debacle because when I talk to business owners, they can't find any help.
Yeah.
When you look at the unemployment numbers, they're super low.
Yeah.
And then there's another segment of people that I've been talking to that can't find a job. And I'm like scratching my head. Wait a minute.
Yeah,
all these people are telling me they can't find a solution.
And then you hear all these layoffs too, right? With all
correct.
These big tech companies. Huge layoffs.
Correct. Correct. Now, some of those, I know. What is the truth? I don't know what to believe.
Yeah.
And data is a funny thing, right? Because I could put up a chart that looks great.
Yeah.
And you say, geez, that looks like a great stock chart.
Mm-hmm.
And it might be like 3 weeks of performance.
Yeah.
And I could show you any 3-week chart that looks great or horrible.
Exactly.
Right. So you can skew that data to tell a story, the story that you want, right?
Yeah.
Under a different lens. So I want to be careful about data and how it can be skewed using charts and things like that. But there is kind of a discrepancy, I think, between the number of people looking for jobs, the jobs that are out there, and the unemployment numbers. Something is not making sense somewhere.
I don't know. It doesn't surprise me anymore.
At any rate, I mean, we don't know if a recession will happen. Maybe I'm dead wrong. I'd be wearing egg on my face next year. Maybe for a few episodes, I'll wear some egg on my face. But time will tell, right?
Yeah. Well, what I hear, 50% are saying yes, 50% are saying no. So I don't know.
Coin toss.
Yeah. Well, let's see what happens,
Hopefully a little better than the coin toss I saw at the Buffalo Bills game this past weekend.
Why did that get messed up?
No, just the game. I mean, you know how it goes. Fourth quarter.
Crazy.
Third and fourth quarter. I don't know what's going on with Josh Allen and the team, but it doesn't look like the poise that I'm used to seeing out of Josh. I mean, he's a phenomenal player.
Yeah.
But I'm seeing more and more mistakes happen in the third and fourth quarter.
But
multiple
they're
interceptions.
Saying he plays best in the playoffs. So when he gets
let's
to the
make
playoffs,
it there. Let's make it there, please.
Non-stop.
Let's make it there.
That's the key. making it there.
I know. It's always been tough to follow the Buffalo Bills. I mean, you think about the late 90s, how many 4 Super Bowls, no wins.
Don't remind me.
And multiple playoffs, disappointment after disappointment, but we stay strong. Got to support the team.
Bills fans, come on.
That's right. I don't know how we got on that tangent, but anyhow, with that, let's take a quick break and we'll be right back with the show. Do you want help building and managing an investment portfolio that's right for you? One that will help you maximize growth potential while you're saving, help you generate income when you need it most, and eventually preserve what you've saved to leave to your beneficiaries? We do this day in and day out and take the stress and responsibility of making those decisions off your plate. Subscribe to our newsletter, read our blog post, and listen to our podcast to get a flavor of how we do things. Our firm is unique and capable of handling all your investment and insurance needs. Monarch Wealth Management, our guidance, your future.
We are back with the PennyWise Financial Podcast with Constantine Kitrinos and myself, Jason Georgiev. And my voice just gave out.
Wow, you just lost all your vocal power. I don't know what happened. You took it from like a level 9 to a level 2.
To a whisper.
Oh, wow. The stock market whisperer.
Oh, wow.
Anyhow, let's move on to something. Let's keep our day jobs here. Let's now take a look at some of the things that we've helped clients with recently. And I think it's important, as people start to question whether they should be investing. And it's a common question that comes up about cash and what to do with the cash. And so you have a couple different options. Number one is, what do you think the banks are paying right now? So if you kept this money, let's say you had $100,000. Mm-hmm. So you had $100,000 in a savings account. What do you think that's paying right now?
Very low. They've always been very low. I mean, recently, I guess.
What would you say low?
Under 1%.
0.5%, maybe?
Maybe. That's great if you get that.
Maybe 0.5%.
Yeah.
Okay, so that's option one. Option two is maybe you put it into a CD. And what do you think a CD is paying? Maybe
3?
0.75?
Or,
maybe 1?
They're not higher?
Maybe.
CDs?
I mean, if you go out a couple of years, I think I've seen an ad for maybe 2.25%. I forget which bank.
I just had a client call in and tell me that he had found a 6-month CD for 4.4.
4.4.
Yeah. And he needed to talk to us about it and see if we can do something with that.
Well, I'll tell you what we can do. I just did this for a client the other day. We've talked about it on multiple shows. You can buy treasuries.
Yeah.
Right? Depending on the maturity, you could have multiple maturity dates. Mm-hmm. You can have mature in February, maybe March, maybe April next year, and grab, let's say, 4.5 to 4.6, 4.7. Mm-hmm. You've got a nice coupon depending on the type of bond that you're buying. If it's a note, if it's a bill, if it's a treasury, if it's a corporate. But yeah, we can buy, and we have been buying for clients some short-term money, short-term bonds. You hold them till maturity. So that's a drawback, right? You don't want to sell them there before they mature. Mm-hmm. And you've got your principal intact.
Yeah.
Is it going to make you rich? No. Is it going to keep up with inflation? No. Is your CD going to keep up with inflation? No. And the other thing is, and I don't know if you know this, but we have access to CDs as well. Mm-hmm. Did you know that?
I think so. Yeah.
Yeah, we do. We can shop out, right? Yeah. We can shop around. It might be Citibank. It might be Bank of America. It could be a regional bank that offers a CD. And why are they looking to offer these promotional rates for 3%, 4%, 2%, whatever it might be? Any idea?
Just because people are looking to be a little bit more conservative at a decent rate and find something decent other than going in the stock market where they're losing 30%.
So that's the consumer.
Yeah.
The banks themselves are looking to raise capital. What are they going to do with that money?
I don't know.
Some of them will be investing in treasuries with some of that money, but they're going to lend it out.
Oh, okay. Yeah.
So Jason, why don't you come in and deposit your $1 million with me at my bank? I'm going to give you 4% interest, right?
Yeah. They're going to use your money, basically.
I'm going to then take your money.
Yeah.
And I'm going to lend it out at, let's say, 7 or 8 or maybe 9%. Or maybe I'm going to do it at a variable rate.
Yeah.
So now I'm paying you 4 and I'm lending it out at 8 or 9. I'm making 4 or 5% on your money.
Yeah.
Not my money, your money.
Your money. Yep.
What did it cost me for that transaction? Nothing.
0.
You brought in the money.
Yep.
What a great business model.
Yeah. We should open a bank.
I said this many, many times. If there were 2 other business ideas that I would do, I would open a bank or I'd open an insurance company.
Yeah.
Now, they're not easy to get started, right? Because you're sharing the risk.
Yeah.
Right. And there's some risk implied there. I mean, with a bank, you've got overhead, you've got employees, you've got staff.
Just like any business.
Any business has risk. There's no investment that goes without risk, right? Everything has a risk to it. Even money under your mattress. House catches on fire.
Yeah.
Not you personally. I'm not trying to put that on you or anyone, but yeah, I mean, there's some risk. Did I ever tell you the story about my clients out in the rural region? So we covered pretty much from anywhere from Buffalo out to Syracuse, down south to Horses Heads and Horse Heads and Lindenville, Oakville, Elba, all these places, places I never even heard of, places I don't know how to pronounce, obviously. But I've had some pretty unique stories of people that tell me that they put money in the ground.
They bury.
Like legit, they bury the money in the ground.
Yeah, I've heard that before.
And people have come into the bank in these old tin boxes and like money is like wrapped in plastic, right?
Mm-hmm.
Well, I guess, I don't know if it's some kind of insect that got to the money, but it's like deteriorating over time.
Really?
It didn't hold up. And it's got like holes in it. And they got to send it out to see if it has any value. When the money is like ripped in half, you come in with a half $100 bill. Are they going to give you $100? They're not going to. So some of this money is damaged. I mean, but to me, it's insane that I would I'd be in a client. And this is serious. Mm-hmm. Meeting with a client out in a rural region, and they give me their name, their address. We go through a profiler like we normally do, right? And they tell me, yeah, I've got about 150,000 buried in my backyard. And I kind of look at them like, when they're going to crack a smile, when they're going to start laughing,
Yeah. It's
not a joke. They're serious.
Mm-hmm.
I said, what do you mean? And they're like, oh, well, it's in different spots. How do you know where it is? What if you forget some of the money?
Yeah.
Like, to me, that's scary. Like, I can't even comprehend it.
What if you pass away and nobody knows it's there?
I'm sure that probably happens. How many times do you see these like you see and read these stories? I don't know how much truth they are. A family goes in, buys an old farmhouse. Mm-hmm. They start renovations. In the wall, they find money that was like put behind drywall or plaster and lathe. Find like $500, $1,000,
or objects,
knife, handgun. And all of a sudden, I'm going to call you Matlock. You're solving a mystery.
Yeah, but people do that. They don't trust the banks. They don't trust institutions. So,
well, I think that's kind of the concept too with short-term money for people that are looking for alternatives. Right now, they don't trust the market. They don't trust right now the condition of the market. But let's put it this way. Let's say we do have a recession. Let's say I'm right and you're wrong.
Yeah,
I like hearing that. I'm right, you're wrong.
Yep.
If that does happen, how much does the market go down? What'd you get? I mean, recession.
Recession?
Yeah, recession.
30%.
All right. Let's say 30%.
Over a period of time.
Right. So your 100,000 you invest today versus waiting. Put in 100,000, it's down to 70,000, right? 5 years from now, where do you think that account is going to be? Higher or lower?
Higher.
Yep. Do you think when you look 5-10 years backwards at 2022, you're going to say to yourself, geez, I wish I waited 6 more months?
Yeah.
Probably not.
Yeah.
Probably not, right? It's going to be kind of a blip on the radar.
Yeah.
But I think sometimes people overthink things. And this is where we say most mistakes happen because people say, why invest in anything? Jason just rattled off 3 of the big names, 3 of the big indexes. Mm-hmm. Dow Jones, NASDAQ, S&P. They're all negative.
Yep.
There's no hope. Go to cash.
Yeah.
Not even bonds. Just go to cash because I don't trust interest rates either. I don't trust anything.
But like you're saying, look at the 5-year.
That's what I'm saying.
Yeah.
So, the flip side of the coin is when I say that there's going to be a recession, I don't say or suggest that people sell out of all their stocks or any stocks. Mm-hmm. For some folks who are very terrified, some folks who are near retirement, some people that are looking or depending on that money for income might be looking at things a little bit differently than you and I may be, than a 35, 45-year-old client, right? So everybody's a little bit different. It's hard to give any kind of blanket advice. That's why we never give advice on the show. Meeting with clients and having those individualized, personalized, catered investment portfolios, I think is a big differentiator, right?
Big
Instead of just a model. Jason, you're 35.
You have to take that into account, though.
You got to be balanced.
Yeah.
You're in a 50-50 model.
Yeah.
We don't employ any of that kind of investment philosophy where every client has to be 50-50 stock and bonds. Just doesn't make sense.
Everybody's different.
Everybody's different.
Yeah.
Right? Even the fixed income, we're looking for different ways to make money, to preserve principal, to protect. And there's some alternative things we can do that we can't talk about on the show, but with a meeting and, some due diligence, I think we can have those conversations and have it make sense for clients.
Mm-hmm.
Blah, 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 blah. That was a tongue twist. That was a long.
Definitely. I'm just looking at the NASDAQ right here, 5-year.
Okay.
Up 65%.
I should have been up 75.
The Dow, 43.
Yeah.
Positive. Long term, if you're looking at long term, maximum from the Dow, we're looking from 1990.
1990. Okay, let's hear it.
Up 3,192%.
From 1990.
From 1990. So if you're young, right, and you're investing, your money's going to grow.
It's going to grow.
That's it.
It's going to grow. With that, let's take a quick break. I'll be right back with the show. Do you have a high deductible insurance plan? If so, have you set up your HSA? There's a ton of people who don't know what it is or how it works. Even worse, there aren't many people who can give you advice about how to make the most of these powerful and unique programs. Not many advisors focus on this in their practice, don't understand the mechanics of how they work, or even where to begin helping their clients. Reach out to me, Constantine at Monarch Wealth Management, and I'll guide you through this process and get you on track to make the most of your high deductible plan and your superhuman HSA. Welcome back to the PennyWise Financial Podcast. This is Constantine here at Monarch Wealth Management with my co-host Jason Georgiev. Welcome back to the show, everyone. This is the final piece of this podcast, Wednesday the 16th. And we've run through a bunch of different numbers. We've run through some scenarios about long-term investing, short-term investing, looking at interest rates, fighting inflation, fighting everyone, fighting the world.
Wow.
A lot of fighting.
It's a lot of excitement.
A lot of excitement. Yeah. So what about we talked about the domestic markets, and we really haven't touched on any international. I think it's worth pointing out. Number one, the international markets have a number of problems. In general.
Mm-hmm.
So they've got currency issues, right? When the US dollar versus the Chinese yen or whatever it might, Japanese yen, whatever it might be. You've got some political influence as well, right? Who's in power? It's always been a question to me on whether or not I should buy some international property, real estate.
Mm-hmm.
Is the government one day all of a sudden going to come in and just say, you know what, you don't own that property anymore, Jay?
Exactly.
It's my property.
Exactly.
They could do things that may not be kosher here in the U.S. Although some things we do here domestically are not always up to snuff either. So anyhow, so the foreign markets, we've really kept, our exposure to foreign markets down quite a bit. Mm-hmm. And we would argue that you're going to get some international exposure because let's face it, a lot of companies right now are international. Think of a company. I'm looking at the sign right behind you. I'm looking at Coca-Cola.
Mm-hmm.
You could drink Coca-Cola here. You could drink it in Zambia. Dave goes to Zambia all the time. We got to have Dave on the show.
Mm-hmm.
But he tells me that they have Coca-Cola. They have what? Fanta?
Yeah, all the big name brands you're talking. Yeah. They're all over the place.
Jeez.
It's dry.
I'm losing my voice here. Yeah, so you could drink Coca-Cola here, but think of it as more of a domestic company, but it's international. You got some exposure there. We get a chart, a report from LPL every week. It's kind of a snapshot on the market as a whole, and they look at different pockets. One of them focused on UK and their inflation rate.
Mm-hmm.
Any idea how it's doing? You know it's not good.
I have no clue. I know it's tied into the U.S. market and everything. I mean, every really global economy is, right?
Pretty much for the most part. I mean, I'd say, markets don't trade in lockstep. I mean, I think there's certain areas that are worse than others, but the UK inflation hits a 41-year high.
Yeah, like
very
15,
similar to the US.
Or are they lower?
Well, excuse me, coughing in everyone's ear here.
That's fine.
Inflation in the UK rose 11.1% from a year ago.
Wow.
Yeah. So, I mean, I think that the markets are very similar. We talked about this on the last show about inflation and interest rates. 40 years ago, we were back in the late 70s, and believe it or not, that's 40 years later. It makes you feel old. Makes me feel old.
Mm-hmm.
How about a flight to quality? Status is reconfirmed. Risk appetite returned. Okay, so what are they talking about here? Interest rate markets. So if you notice that the core CPI numbers came in last week after the election results came out.
Yeah.
What was that? Wednesday morning. Market is down 600. Day after, CPI comes out. CPI comes in lower than expected.
Mm-hmm.
What happens to the market?
Boom.
Market starts to rally.
Yep.
Not about any political influence, but about interest rates. That's what it's about. And I mentioned this on the last show that the Fed, Jerome Powell, and the Fed is our worst enemy right now. Mm-hmm. Not personally, but because of what they're doing, it's killing our stocks.
Yeah.
It's killing our investments right now. And I can understand that. I mean, I think people are looking for better quality names. We're looking at value type stocks. We're looking at stocks that pay consistent dividends, healthy dividends in a rising rate environment when people are not willing to pay for things, multiples in earnings that are going to come years down the road.
Yeah.
Companies like a Tesla, companies like a charging station that has no users yet.
Yeah.
Those kind of things. How about small caps? So I heard an analyst the other day on TV on one of the channels. I don't know if it was Fox Business or CNBC or CNN or whatever it was. Mm-hmm. But they were talking about recessions. And they were hinting that we're on the verge of a looming recession in 2023. And one of their guests suggested that their clients and the way that they're managing money buy into small cap stocks. Any idea on what the impact of buying a small cap stock going into a recession is like? So think about a smaller company, small, mid-sized, and large-sized companies. Large-sized companies like a Coca-Cola, large cap company, right? It's not going to be making you 20 or 30% a year.
Yeah.
They put Coke in a bottle and sell it to whoever they can.
So you're talking about your bigger companies when you say large cap.
Correct.
Small cap,
capitalization.
Smaller. Yeah.
When you think of a smaller company, they have less cash reserves, but they also trade at lower price to earning multiples. In a recession, those companies that don't have as much built up cash reserves for slow times could feel the impact quite a bit.
Yeah.
And so if you're going into a recession, small caps are not necessarily the best place to be.
Yeah.
Coming out of a recession, what do you think the best place to be is?
Small cap.
Small cap.
Yeah.
Coming out of a recession, they've been hit probably the hardest, trading at much lower multiples, and they're the first ones to rebound. Typically. Doesn't mean all the time.
Yeah.
So again, they kind of chastise this guy. This poor guy is on the show chanting that he thinks that small caps are the place to be right now, not after the recession or if we do get a recession, but claiming that is a good spot to be right now.
Yeah.
So we do have some allocation to small size companies, small, mid, and large.
Yeah.
I don't think it's a game where you shift all of your money from large companies to small or vice versa. It's not all value or all growth. Having a blend, but maybe making these small minor tweaks along the way to amplify to get the best result for our clients. It's the best way to do it. There are this last point that they have on this message. 3 things to know about a recession. Again, this is playing into the theme that we are going to have a recession.
Yeah.
And chances are you will not know we're in a recession until afterwards. Kind of crazy, right?
Yeah. You don't know it's around you.
The market is typically forward-looking.
Yeah.
So if you think about it, the market is down anywhere from 20 to 30%. Tends to be 6 to 12 months forward-looking.
Yeah.
So think about that for just a minute. So if this is a bottom or we're starting to form a bottom in the market and it starts to improve slowly in the next 6 months, when did the recession happen? Was it 2022 or 2023? You know what I'm saying? You see what I'm saying?
Yeah, I totally.
So if the market already went down,
yeah,
and we're not quite in an official recession.
Well, yeah, that's why you hear people on TV. Well, we're already in a recession. They're always saying stuff like that. Because you don't know until after. Like
correct.
You said, like
correct.
2 years from now, the recession of 22. That's what we're going to be saying.
That's right. It's very hard to understand when you're in. It's kind of like, no, I'm not gonna go there. But I was gonna go with a comparison, but
employment rates, right?
Mm-hmm.
They're saying we're already in a recession, but unemployment is at an all-time low, right? Doesn't
correct.
that? I mean,
there are a lot of things like that. If we look at different metrics and data points that don't make sense, that just don't add up.
Yeah.
If we're in a recession, why are we at a near record low unemployment?
Exactly.
We're in a rising rate environment, not a declining rate environment, where you have to loosen up money and make it easier for the economy. Kind of some weird things led up to this in the last 5 years. And then you had COVID smack dab in the middle.
Yeah, COVID destroyed everything.
COVID really changed the dynamic of how people operate their businesses. Mm-hmm. It changed the mindset of people, what people find valuable anymore. It's a lot less focused on relationship. And even when you go out to eat, we talk about this all the time. Mm-hmm. The level of service has gone down quite a bit. Yeah. The quality of food to me has gone down quite a bit. Prices are through the roof.
I agree.
But it seems to be staying. It's not like it's going to change.
Yeah.
And think about this. If you own a restaurant and your omelet is $5, right? And then prices go up and force you to raise the omelet price to $7. Mm-hmm. When prices go back down, are you lowering your prices?
Nobody is.
Nobody is.
Nobody is.
No one. No. That happens never.
The only prices I know that will be lowered is at the grocery store for things like chicken. Now you're paying $5.99 a pound for chicken breasts when it used to be $1.99. That will eventually go back down, in my opinion. Things like that.
And those are expenses that we can't really control. We have to eat, right?
Exactly.
We have to heat our homes. We have to put gas in our car until they mandate electric only. Though all those things play a role. So anyway, I'm going to get into the 3 things about a recession so we can end the show. Okay. 3 things about recessions. Number 1, if the economy enters a recession, the causes and potential outcome will be hotly debated. At LPL Research, our starting point is always to look at history. Okay, so they look at historical. Now, history is a great way to get an idea of what has happened before, but I think every recession is a little bit different. Yeah, right?
Definitely.
The reasons why we go into recession are very different in each case. In the latest LPL Street View, as a chief economist, Dr. Jeffrey Roach, he discusses 3 things to know about recessions, including what defines a recession, the warning signals, and recession's history with market declines. Again, I think it's very hard to look at each one of these recessions and say, oh, X happened, so I'm going to do the same thing this time. Yeah. I'm going to go ahead and buy the small caps on X date and make sure that I profit from that. You can't. History does not repeat itself exactly, right? Mm-hmm. It rhymes many times, but it doesn't repeat exactly.
Yeah.
And so they mention these points with chief economists, and I'll never forget this. So years ago, Dave and I did a due diligence trip, and we went out to Seattle. Yep. Okay. The room was filled with market experts, filled with market experts. Mm-hmm. There was probably 15 different guys and gals that had every degree possible. Mm-hmm. And at that time, this is 5 years ago. At that time, they said the best place to be was the international market. Yeah. And the way they were managing their portfolios, 45 to 50% of their money was international. Mm-hmm. Boy, were they wrong. So it's like you can have all the credentials you want. You can be a doctor and you have a license to practice. You can be a financial advisor with your license and go out and manage money.
Yeah.
But it doesn't always mean that you're going to get the best result. Mm-hmm. And I think that's why we have to take things in stride with careful planning, and mistakes will happen. We want to try to find the best solutions. And I think that's appropriate for most clients, is taking inventory of what you own, finding the things that are not working or not performing, and eliminating or reducing exposure there and putting the money to work where it should be appreciating. Make sense?
Makes sense.
Seems easy enough, right? Just make money.
Yeah, just do it.
With that, I think that's all the time we have for today's show. Thanks again for listening to the PennyWise Financial Podcast. This is Constantine here at Monarch Wealth Management with my co-host, Jason Georgiev.
Take care, everyone.
Thanks again, everyone.
You've been listening to PennyWise Financial, brought to you by Monarch Wealth Management. Constantine and David really care about their clients. They want to make sure you're happy, so you'll continue to hire them. There's no commitments, and clients are free to leave whenever they want. Think about being able to pick up the phone and call someone for guidance and advice on almost anything, from buying a car, selling a home, buying vacation properties, or even selling a business. Reach out on the website at monarchwealthmanagement.com. There are 2 offices in Rochester and 2 offices in Buffalo. Reach out to us on Facebook, LinkedIn, Twitter, and YouTube, or call us toll-free at 800-480-1580. That's 800-480-1580. Until next time, this is PennyWise Financial, signing off.
The opinions voiced in this program are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine which investments may be appropriate for you, consult with your attorney, accountant, and financial advisor or tax advisor prior to investing. Securities are offered through LPL Financial, member FINRA, and SIPC.